Welcome back. Actually, it is good to be back, Josh.
You weren't here last week.
I was not here last week, and for those who are unaware, I bailed on Josh last Wednesday. I was sick. I left him here to fend for himself for an hour plus talking and just scratchy voice and the whole thing. So it's good to be back. I'm happy to be here. We're going to update you a little bit on what's happening in the real estate world, if you will. Then we're going to get into some questions from you guys and, kind of carry us out through the end of the year. So, Josh, big news today, if you will. Existing home sales came in once again down for the 10th month in a row. Sales are down, 35% or so year over year. So a big drop in the number of properties actually closing escrow. And as we all know, it has a lot to do with affordability, a lot to do with interest rates. And speaking of rates, we've seen interest rates come off of those 3-month lows. We saw, you and I were talking last week towards the end of the week, and we, people were getting loans again in the fives on some products out there. I don't know where we are at the moment. I'll have you update us here in just a second, but we've seen rates trend up a little bit. We've seen the 10-year trend up a little bit. So is it normal? I guess is one of the questions I'll ask, right? I mean, one thing that I read and watch is that there's less traders in the market right now, right? A lot of people have taken off for the holidays, right? A lot of the interest rate traders, the bond traders, these guys are already on vacation. So the impact in the moves is greater because there's less people actually making these trades one way, one direction or the other. So a smaller number can influence the direction that we go. So do you feel like that's part of it? And are we waiting on CPI data, kind of like we were last month? What are your thoughts on rates, Josh?
Yeah, pretty much. That's exactly what we're looking at. So let's look at the slide here. You covered the existing home sales, but this little green band here, this is what we were expecting through the end of the year. That's the 10 from like 3.4 to 3.62, and then you'll notice we are not between those pretty two green bars. Yesterday, the Bank of Japan surprised everyone. They artificially suppressed. They put a limit on their treasuries, and they doubled it. They allowed them to go from 0.25% to 0.5%. Caught everyone off guard, and it kind of pushed us up out of this range. Really, if we took that top green bar, we could just push it higher, just widen the range that we're in. Now, within that range, weird stuff can happen for the exact reasons that you were talking about, Jeb. Most of the big major traders are vacationing. They've closed out their big positions.
Are you talking about me? I'm still trading, bro.
Exactly.
I'm still here.
There are traders there that will use this time knowing that if you want to make some money, you can push the market around a lot easier than when it's more liquid and there are more traders buying and selling. So with that, you get big swings between the bid and ask prices. It takes us, usually by 9 o'clock in the morning Pacific time, the trading is settled out and you kind of see where it's going to look at for the day. And we still haven't even got liquid by that time, most mornings here. So it's hard to draw any conclusions. I would say fairly safely that all eyes are on the beginning of next month. What is it? The 10th, 12th, 13th, something like that we're looking at for CPI data. We do get PCE on Friday. PCE should confirm the CPI. The CPI is actually a secondary measure for the Fed. The Fed prefers PCE. They think it's a better measure of inflation. But the problem with it is when inflation really got out of hand in June, it was the CPI report that led PCE. So now everyone's kind of trading CPI, thinking PCE will fall in line with that. And that's likely to be the case. So we could see some improvement on Friday with a low PCE reading, but we're still going to be in between those green bands. It's all just noise until we get into next year and everyone gets back at their desks and decides where interest rates are going to go from here.
No, absolutely. And one thing I didn't mention earlier with the existing home sales report that came out is, as many of you guys know, we, not only do we have less sales, we saw inventory come up considerably over, the last couple of months. But recently, we've actually seen those numbers retreat a little bit, even though we're sitting at 3.3 months of inventory nationwide. We're now starting to see those numbers dwindle a little bit. And it has to do with seasonality. It has to do with the time of year. Here locally, we update it every week. We're looking at 2,706 properties here in Orange County. Just for reference, we started the year just under 1,000, which was incredibly low. We saw it go over 4,000 at the height of the market. And typically this time of year, we're sitting, 4,000 or 5,000 homes on the market this time of year. Today, we're sitting at 2,706 properties. So inventory is still very, very low, especially historically speaking. And I, don't be surprised, when we come back next week for our final show of the year and you hear those numbers under 2,500. You're likely to continue to see them dwindle, and that inventory is going to stay low for the first couple of weeks of January, and then it'll start to pick up again as we head into that spring market. Here in Huntington Beach, we're sitting at 185. Huntington, I don't remember exactly where we started the year. I think it was like 60 or 70 properties on the market. We saw it as high as 275-ish, somewhere in that ballpark. And today we're sitting at 185. So we're going to see those numbers probably dwindle a little bit further as well. It's the market. It's sellers taking their homes off just because they're not getting the action, just because they're going to reset, probably come back in the spring. Some of them are people just trying to see if they could have gotten their price. They didn't, or they're not. And therefore, the numbers are going to reflect that. I mean, I don't remember if you guys, just a little side note here, a couple months back, I said, what's really deceiving about the market that we're in is that when you see properties listed, for example, I mentioned my neighbor's house was listed at 1.2 million. And if you guys remember, I said, hey, listen, that house is 100,000 overpriced. And so when that property sells, it's going to sell for 1.1-ish. And it's going to show that they sold for $100,000 less than the asking price. And on paper, that's going to look really bad because it's going to look like, crap, they had to take a bath in order to sell that property. But if you remember me mentioning it, that property wasn't a $1.2 million property back in May at the top of the market. It wasn't. But for whatever reason, they thought, hey, let's list it $100,000 higher than it should be in an environment where things are pulling back, where the market's changing. Let's just throw it out there at some crazy number. Well, guess what, guys? It closed last week and it closed at $1,075,000. So I was $25,000 off on what I thought it would sell for. But again, the reason I bring this up is not to say, every house out there is overpriced and that's the reason it's selling for less. But there are a lot of them where they're just overpriced to start with. And that's the reason you're seeing these properties sit on the market a little bit longer, things selling for, a reduced price versus where it was listed, sellers having to do things. It's the market for one, yes, but it's also, agents, it's also sellers doing things, incorrectly to start with, not incorrectly, but not putting the property in the best position to sell at the max price at that time. So just thought I would update that. Josh.
Jeb, what I want to know is, does your neighbor watch the show and are you guys still friends? Do they blame you for talking down the value of their home? Is it your fault?
Everything's my fault, Josh. No.
Okay.
My neighbor's older. And they had a
So
long-standing relationship.
She doesn't YouTube?
She might watch us on YouTube. And finally got wind of where we thought the price was, and that's why she accepted something lower. You just never know.
Perfect.
But Josh, let's talk about something we haven't really.
Jeb, before we jump to that, let me piggyback on some of this existing home sales data here. There's some things that we're seeing that are bearing out the hypothesis that you and I had earlier in the year. We have lots of people who are screaming, housing market's crashing, housing market's going to drop 15, 20%. And that is possible. But going back to what you said, affordability is going to be the driver of that. The big thing that has impacted affordability is rates doubling in the last year. So what we saw over the last 5 weeks is that purchase applications increased. They were flat week over week and rates were flat week over week. Figure that one out. But as rates came down, the payment on a median priced home dropped $200 a month over that time frame. Applications increased. So there is a baseline of people in the market who want to buy, but the home has to be affordable to them, and interest rates will determine the direction of that. But the important thing for anyone who wants to be in the market or is an owner and thinking of selling or would like to sell, would like to move up, move laterally, move down, whatever you want to do, the thing that we have to look at here is this is not the last market. Most of the people that are calling for a crash are not in this business. They don't make their living in this business. They want to make YouTube videos. They want to get headlines. The news media wants to get headlines. Analysts want to get attention for themselves. Affordability is what's going to dictate where we go from here. If interest rates come down and normalize, we should have a floor underneath home prices. If interest rates continue going up, home prices will suffer. And these numbers are telling us that, because what is happening, we don't have a supply-demand imbalance, because while affordability is making demand decrease, those sellers would be also buyers in the market, and they're choosing not to sell. So we have a balance between supply and demand that is supportive of prices. Now, it doesn't make them bulletproof. Does it mean they can't come down? Absolutely not. But interest rates and how that bears out on affordability will be what drives things. If you've watched us here, you know that I believe that interest rates are going to move lower next year. Nowhere near where we were to start the year, but better than where we were a month or two ago. And when a payment is $300, $400, $500 lower per month, that opens up the pool of willing and able demand for those properties. Now, conversely, what it's also going to do, it will bring out some more supply, because some of those sellers who are not selling because they don't like what the payment looks like will come and sell as well. But those are the two big things that we're going to be looking at.
No, for sure. And let's talk about something else. I mean, I know a lot of people have done videos on the loan limit changes, but let's just kind of go over that real quick, because it can be difficult to understand. And the reason I'm bringing this up is because this can potentially help some people that were kind of in that threshold get a little bit more purchasing power, if you will. It's going to help areas like Riverside, San Diego, San Bernardino, some of these areas where they had lower loan limits, if you will, qualify for a little bit more property. And because prices have gone up, the fact that the loan limits have been moved upward is going to essentially help people. So, Josh, I know you have a couple slides here you want to add to this, so let's add it in there, and then we'll start answering some questions.
Yep. So, simple question here. For most areas of the United States, $726,200 is the loan limit. That allows you to do any and all mortgages through Fannie and Freddie with one unit. Now, you'll also notice if you go 2, 3, 4 units, very few loans are done on duplexes, triplexes, and fourplexes relative to the volume of single family and condos. But those go much higher, up to 1.4 million almost on a fourplex.
And Josh, one thing I want to touch on when you say that, you'd be surprised how many people don't know what units are. And I'm not digging on that, but it's a question that comes up often in videos when I talk about units. A unit is essentially a door, a front door to a property, right? Occasionally, it might be a building that has 4 units in it, 4 front doors, 4 people live in that particular building. That would be a 4-unit property. Occasionally, it can be 4 little properties on one parcel of land, right? I mean, that would be considered a 4-unit deal. And so conventional financing, FHA, VA, all these ones that Josh are going to talk about allow you to finance up to 4 units. That's considered residential property, and the loan limits go up with that. So that's essentially what we're going over.
So for simplicity's sake, let's ignore Alaska, Guam, Hawaii, and the U.S. Virgin Islands. Very few of you are there. In essence, what they get is they get high balance loans. So high balance is 150% of the standard balance loan limit. So it puts us at $1,089,300 for 1 units, all the way up to $2,095,000 for 4 units. Those are pretty darn big loans. So looking at it, what areas in the United States qualify for those high balance loans? Anything in gray, you do not qualify. You are not eligible for high balance loans. These other areas here, the dark orange ones there are the full boat, 150%. And then the rest of them are lesser amounts. So you don't necessarily get the full high balance. Like San Diego is one that is puzzling to me. We've talked about it here, that San Diego has kind of come into parity with Orange and LA County. I don't know that, to me, there's really any discount for living down there, but their loan limits, they don't get the full $1,089,000. They have a slightly lower amount.
And Josh, something I want to mention, when the government raises the loan limits, when Fannie and Freddie FHFA raises the loan limits, that doesn't put the economy, doesn't put the mortgage world at any more risk of default than it was prior to. People hear that and they go, oh, we're headed for 2008 again. They're allowing people to now get $1 million loan back by
the government's helping millionaires buy homes.
Yeah, that's not the case at all. They've been doing this. They've been raising these loan limits for better part of 20 years. Some years it doesn't go up just because prices, the median home price doesn't necessarily go up year over year. But this does not change anything. It just helps more people get qualifications in areas like California, where it's very, very expensive to buy a house.
So with that, you talk about California, where it's very expensive. Basically, if you look at this map, those are areas that are very expensive. So which states have them available? California, Washington, Idaho, Utah, Wyoming, Colorado, Tennessee, Florida, Massachusetts, New York, New Jersey, Pennsylvania, Maryland, Virginia, and New Hampshire. But if we go back and look at that map, what do we got? We got Jackson Hole, Wyoming. We've got King County, basically Seattle, Bellevue, Washington. We've got the Bay Area. You've got New York and New Jersey, the big financial centers. You've got Maryland and Virginia around Washington, D.C. Again, super high home prices. The Keys down in Florida, and some of these pockets here in Tennessee have increased in value. So it's expensive, high cost areas, high cost of living areas for the most part. So if you're in one of those areas and you're buying there, you may have access to a high balance loan. So I wanted to throw this one up here, Jeb. I thought this was interesting, and it's also helpful to understand this is not political. Doesn't matter who's in the White House. The FHFA looks at their index year over year and they say, here's the new limits. It's a calculation. No person is in control. And when you look at this chart here shows you from 2006 to 2017, we had no increase. It was $417,000 was the maximum standard Fannie Freddie limit. And then now you've seen, as home prices have increased, it's gone up rather rapidly. And I would expect that next year, I would say with 90% confidence that home prices per the FHFA index will be somewhere between -5% and +5% next year. And if it drops 5%, then we're not going to have any increase. We're not going to talk about a 2024 increase. If it goes up 3%, 5%, we're going to be talking about a little tiny little increase over year. So we'll see. We're going to see how that plays out. So want to talk about FHA loans. Jeb, you just did a video that's getting a ton of interest on everything you need to know for FHA for 2023. FHA does this a little bit differently. They have floor and high cost ceiling, and then they have tons of counties. Most counties are at neither. They're not at the floor. They're not at the limit. They're somewhere in between. So you have to go out, Google it, look up your county or the county that you're interested in buying. The floor, the lowest limit FHA would have is $472,030. You can get all the way up to a high cost area, and they have the same limits as Fannie and Freddie do at $1,089,000. And it's also there indexed for units. So we've got some fun ones here. We got a trick question. What is the maximum VA loan amount for 2023? It's a trick question because there is no maximum. Lenders will put a maximum on it, but VA says we will insure any loan amount, zero down, for any veteran that qualifies. So in the real world, $2.5 million with zero down is probably the best we're going to see. A lot of lenders put a ceiling on that at about $1.5 million, but it is not a VA imposed limit. Last trick question is, what is the maximum USDA loan amount for 2023? USDA doesn't publish maximum limits because there is no maximum limit. What they do have, you have to be 115% of the area median income is your income limit, and you have to meet their debt to income guidelines. So is there a practical ceiling every year in terms of what that maximum loan amount is? Yes, but it's not one that they publish. It's one that they back into with having a USDA eligible property, meeting the income limits and meeting their debt to income requirements.
Good stuff. So hopefully you guys found some value in that. I know there's a lot of videos out there on it. A lot of them don't really go into the detail of what it all means. So hopefully that answers some of your questions. But if you have additional ones, just put them in the chat below. For those of you who are listening on the podcast, we do this every Wednesday. We answer questions live. And for those of you watching live, we actually do this on the podcast on Friday. We take this show, we transcribe the audio, and it's live online, so you can listen to it versus having to watch Josh and I's face every single week. But in addition to that, we talk about topics to educate you as a home buyer. The Educated HomeBuyer is the podcast. This week, we're actually talking about the process of writing an offer. So we just kind of went through a series of, especially if you're starting the year and your goal in 2023 is to buy a house, we're kind of taking you through that journey, if you will. So we've talked about everything of getting a mortgage, going through the pre-approval process. Now you've got a mortgage, finding a real estate agent, writing an offer. So that's kind of where we're at, at the moment, is we're writing that offer, what goes into that offer. So the next 2 weeks are going to be talking about that. And then we're going to be talking about what the process looks like once you're in escrow. What happens? Like, what happens with the inspection, with the appraisal, what happens with the loan, what documents and timeframes and all of that stuff. So if you're not listening to it, do it. Listen to it. Be cool. That's what the cool people are doing. And the cool people share it with their friends.
Don't forget the important part. You talked about you can listen to it if you don't want to see our faces, but if you don't want to hear our voices, we post a transcription also, and you can read it in whatever voice you want and imagine the face of whatever person that you would like to hear reading that to you.
That's genius, actually, Josh.
Yeah.
That would work well. On our dating site, we could have one of the people read to the other person, kind of, just bedtime stories. Read our info. It'd be great. This is good stuff. So guys, there's not really a lot of questions in here. And I know you guys don't enjoy Josh and I that much. So we'll start answering some questions here. But if you're listening to the podcast, I'd love to know let's start off this. Have you listened to the podcast? Yes or no? And if so, do you like it or does it suck? Is it repetitive? Is it information you've heard before? Are you finding any value in it? Those are things that I would love to hear. And if there's something that we're not covering that we could cover, would also like to know that right after you hit the like button. That would be nice as well. So, Josh, there's a couple questions to start. This one's a pretty easy one. Dr. Clark says she closed back in May on new construction. Builder sold the loan, which was expected. However, that mortgage company said it's sold it also in November to Carrington Mortgage. So is that normal? So, Josh, what happens when a lender sells a mortgage? Is it normal for that to take place? And does anything change in terms of the buyer and their monthly payment, their loan, all that good stuff?
Yeah. So depending on the type of loan, some loans are more likely to get sold than others. There are certain times when loans are more likely to get sold than others. The only thing that is out of the norm for this is servicing rights have not been especially valuable this year. We talk about it on the show. With rates up, lenders and buyers of servicing rights, buyers of closed loans, of mortgage bonds, do not believe that these loans are going to stay on the books for the 5 to 7 years that is typical. They think rates are going to recede. They think that these loans are going to get paid off. So there hasn't been as much of transferring of servicing rights because the servicing rights have not been valued very highly because everyone's worried these loans are going to pay off. When you get a different type of market, this can be super common. I've heard of people having their loan sold 3-4 times in a year. It can be highly annoying because you have to go set up a new login, set up your auto payment, whatever you like and how you handle everything. And you got to remember, well, great, who is it now? Who is it this month? So it's not fun, not cool, but it's not uncommon. And there's absolutely nothing you can do to control it. The ownership of the ownership rights of your mortgage are assignable. They are transferable, and it can be sold as many times as the owner of the loan wants to do that.
Good stuff. Jessica has some comments as well as a question here. Jessica saying, typically when in the year is there the most inventory? What month? So what's going to happen is you're going to start to see more inventory come to the market after the first of the year. It doesn't happen immediately, but it starts to trickle in. And so the spring market for most markets, that the good market, if you will, when it's good for sellers, you start to see more inventory as buyers, things start to pick up, starts right after the Super Bowl, right? First weekend of February, but it doesn't really peak in probably until late April-ish, maybe May. Sometime in May is usually when the market is kind of at its full force. That's, just shortly after that's when you're going to see the most inventory on the market, sometime during the summer, right before the kids start to head back to school in those markets, at which point it kind of starts to turn. So I would say mid-June, mid-July is probably when you see the most inventory on the market. The summer gets the credit for the good times, if you will, right? So everybody's like, the summer is the best time to buy or sell a house. Well, that's when most properties close. They close in the summer, but if you understand how real estate works, that means those properties went into escrow 30, 60, potentially 90 days before that. So if something's closing in, say, May, this year the peak, if you will, was in May, that means those properties were in escrow in April, March, potentially, some even in February. So that is going to be the season. The spring is going to be a really telling time for 2023, in my opinion. It's going to set the bar for the rest of the year. Now, I will go out on a limb here and say that 2023 is going to look a lot like the second half of 2022. You're going to see numbers continue to be down year over year, especially through May, right? I mean, May was the height of the market. So when they compare May of 2023 to May of 2022, it's going to look awful. It is. And I'm telling you that 5 months in advance, just because the likelihood of interest rates coming down to something that is going to boost the market isn't very high. So with that being said, whatever happens in the first, probably, I would say 45 days in, from 45 days in until about the end of May, I think kind of sets the bar for the rest of the year with regards to rates, with regards to home sales, with regards to basically everything housing. Josh, what are your thoughts on that?
Just in terms of where the market's going next year, or in terms of her question of inventory?
No. In terms of what I'm saying about that being kind of a telltale sign, the first half of the year is going to kind of dictate the full year, if you will.
Yeah. And that,
you don't have to agree to it.
I don't disagree. I'm just saying what happens with interest rates will have a large impact in it. And here's the fun part, or the not so fun part. What would lead interest rates to improve a lot next year? It would mean the economy is really suffering. Real estate doesn't generally do spectacularly well when the economy is suffering. So will it increase affordability where there'll be some people who can step in and benefit from it? Yeah, but a lot of people, if that's the case, are not going to be as comfortable. So it's sort of as comfortable buying a home or making a big investment in that type of environment. So I think it's likely that we muddle through. There's sort of like a Goldilocks scenario here where the economy struggles enough that inflation gets under control and rates improve, but not too much where people are pessimistic about the future. That, I'm not a big believer that we have a lot of hope for a soft landing, but it also doesn't have to be a just horrific crash for the economy either. So the shorter and shallower that any recession is, and the quicker we can recover from that without getting inflation hot again, will be the driver of it. So definitely, you're right that will look a lot like where we are. And I would say kind of more like the fourth quarter. I would say the last 3 months, as rates have started dropping, has been more active than the end of summer into the early part of the fall, when rates were really high and people were looking at these payments going, holy goodness, what am I going to do with that? So next year is going to be interesting. It's going to bear repeating. That volume is going to be down. And, for people who are used to the last 2, 3, 4 years of being professionals in the industry and transactions just falling out of the sky, or for sellers used to just putting in a sign in the yard and it's easy to get your price, it's not going to be that kind of a market. It is going to be more of a muddle through, more of the same. And I think when we have this conversation next year, we'll have a much better look into what the future looks like for interest rates and real estate.
Good stuff. And Sherry, don't worry about Nightbot.
Nightbot lost its mind. I didn't even see any caps.
Is picking on you, and that's we don't condone that here. But no, it's automated. It's all AI type driven information that kind of helps regulate the chat. So don't sweat it. It's nothing. Nothing's going to happen to you. Jessica goes on to say the podcast has been great. I've never really seen anyone go through the process of explaining escrow, so that's been helpful. Looking forward to the rest of the series, hopefully buying in 2023. So something I want to say about Jessica, she always shares my information on social media, on Instagram, and gives shout outs. So I appreciate that, and I appreciate you and the support. So it's been awesome. Thank you. Rick, yeah, did you want
to? Dina says that we need to get a Nightbot for Nightbot.
That we could do that.
So a double Nightbot. An AI to put the AI in
Nightbot squared. Rick says he's in the market for a $900,000 single family home as a primary residence, has a 5% down payment, 2% debt to income ratio, so considerably low there. Gross 175 per year in income. Would that qualify for a conforming loan? So Josh, we don't know credit score, but we know 5% down will qualify for conforming loan. The 900,000, I guess that the question is, where are you located, right? Is that
Yeah.
a fair
Yeah.
question?
No, it is, because 5% down wouldn't get you down. I'm assuming that Rick was watching here from the beginning, like an astute observer,
Mhm.
and knows what the county limits are, and knows that he has access to a high balance loan. And note, another thing kind of tips us off the 5% down. Under the standard balance limits, you are able to do 3% down. Once you get the high balance, you have to come up with the 5% down, like Rick's talking about here.
Yeah. So in theory, Rick would qualify for a conforming loan, assuming everything else meets the guidelines there.
So look at it, 175,000. It's just shy of 180,000. It's $15,000 a month. Best case scenario, you can go as high as a 50% debt to income ratio. It's a $7,500 payment. He's saying he has a 2% debt to income ratio, which is, a couple $100 a month debt or less. So with that, I'm assuming also a good credit score, likely to be able to go to a 50 debt to income, if not a 45 debt to income. And even with current interest rates, you're looking at the payment well below where your limits are. So yeah, it's not a no brainer where it's a 25% total debt to income ratio, but you should be able to qualify with a conforming loan. And again, depending on where you're at, I don't know where you are, but here in Southern California, all of the Southern California counties, we have access to a program that follows Fannie Freddie guidelines, but they set their own rates and terms, and they don't have some of the high balance hits. So if you're local here, let me know, because we have a program that will definitely be a much lower interest rate than what you would look at with a standard high balance loan.
Yeah, and on top of that, I mean, if you're looking for really a lender, mortgage professional anywhere in the United States, a lot of people have reached out. In fact, 19 of you closed transactions with a real estate agent that I referred to you last year. 19 people in 2023 closed with a real estate agent, and I don't know, over 2,000 people used the referral link last year and got connected with a mortgage professional. So if you need to get connected to somebody, real estate agent, mortgage professional, anywhere in the US, use that link that's scrolling the bottom there. And if you're listening on the podcast, there's a separate link that you can go to in the description of that video. But that'll get you connected, honestly. And there's a lot of positive feedback, guys. So the only negative feedback comes from the people that don't qualify. They get mad. But the people that actually qualify are happy. So, and they're in good hands, which is an important piece. Chris says, why the beard, Jeb?
It's cold.
Laziness,
It's cold.
change the things, just my wife likes it, a little bit of everything. It was a little crazy. This week I kind of took, trimmers, made it look a little bit more groomed. But then I instantly regretted it when I was done that I did that. So now we're back in full growth mode. And, here in California, for those of you who don't know, I know there's a cold front going across the nation at the moment. My family, I talked to him today in North Carolina, it's going to be the high tonight. I think it's like 14 degrees or something. It's not supposed to get above freezing for the next couple of days. California is like really, we're following suit right behind you guys. It's going to be like 75, I think, on Christmas. I don't know what we're going to do, Josh. I don't know if I have any more short sleeve shirts that are clean. I'm probably going to have to do laundry this week because
it sounds like 18 holes on Christmas, Jeb.
It sounds brutal. The weather is frightful out there. But it's okay. Like, somebody has to be here and take care of it. And I guess I'll do it. I guess I'll just stay.
Yeah, but I'm going to be in Rancho Mirage and it's going to be 80. So we're probably going to have to go to the pool.
Ooh, how do you do it? Probably be an earthquake now that I said that.
Fire, tornado.
Yeah, just like something will happen. G Stack says, are assumed mortgages possible for a second property? So this is one of those questions that's difficult to answer, because when people say second property, I don't know if they're talking about a second home, like they keep their primary, they buy a second home, or if they're talking about, hey, listen, getting rid of my property and buying another home, a new home, or if they're talking about keeping their existing home and buying a new home as their primary home. So, Josh, when you hear assumed mortgages, right after Chris Stapleton plays on your phone,
because I can't remember to put on Do Not Disturb before we start.
How does that work? Are assumed mortgages available on all types of properties, or is it just primary homes? Let's talk about it.
It's a really good question. And to say with certainty, I would have to do some research, but lender's discretion. And what we talked about, the two types of loans that are most assumable, VA loans are assumable, FHA loans are assumable. If you go and get a VA or an FHA loan, those are only owner occupied. I would be thinking that they are likely to have a requirement of owner occupancy. So if you're saying a second home, I'm going to leave this home that I own and buy this one to live in as my residence, probably. But I certainly wouldn't bet my life on it. We'll do some research here and report back to you next show.
Good stuff. Sherry Berry says, how to select a realtor. I would like a realtor that is knowledgeable in the neighborhood that I'm interested in buying. Haven't been able to find a realtor that meets that criteria. So here's the thing. Do you need an agent? I mean, if you want an agent that is super local to your neighborhood, then so be it. Is that necessary? I'm going to say no. Excuse me. You need somebody that is familiar with your market, if you will. But typically speaking, you don't need an expert in that neighborhood in order to find a good agent that understands the market and can guide you and what have you. So, but you want to look for people, that obviously are good communicators, people that are been in the business for a period of time, people that have been through more than one market, not crapping on new agents, but, you want somebody that's been through a market where, people have had to reduce prices. You've been able to negotiate. There's a different skill set in real estate agents that have been around for 15, 10, 20 years, whatever, versus those that have only been around for 2. Even if they've watched every video on YouTube and whatever, experience starts to play into that. The more negotiation, more deals that people do, the better they get at their job. So find somebody that's like that. And there's not really a surefire way to do it. Check reviews, ask to speak to people that they've done business with. Like I mentioned earlier, I network with agents all across the country, all 50 states. Sometimes I don't have an agent just because there's not an agent in that location. But there's a reason that I travel a couple times a year to some of these seminars that I go to. It's because I have relationships there with different agents, and I'm continuing to develop those relationships and try to refer people that have done a good job and know what they're doing. And again, that's why 19 people closed last year through me referring them out. So if you need somebody, reach out and doing that. But we actually talk a little bit about it on the podcast as well. So if you want some information on picking a mortgage professional, picking an agent, you can go check it out on there.
Well, Jeb, I was going to say, we did do an episode on how to shop for a lender. We did not do an episode for how to shop for a realtor.
So maybe that's the episode.
We probably need to add that to the list. And again, anything that you guys have that you want to hear, that you would want to hear us go in greater depth than we can do here in a 3, 4, 5 minute answer to a question, just let us know. We're happy to record an episode.
Yeah. And on that, is there other people outside of Josh and I that you want to hear from? Right. Ryan, what's his name? I almost said
Pineda.
No, not Ryan Pineda. What's the dude's name on Ryan Serhant? Sir, what's his name?
Serhant.
Yeah, that guy. He hasn't gotten back to us, probably because I don't know his name.
Probably because
I don't watch a lot of TV. I don't watch a lot of reality TV when it comes to real estate. So some of these people I'm not familiar with. But yeah, he hasn't called us. So who else do you want to hear from? Boy, he's never going to call now. Clara says, I don't have 2 years of consistent work experience, but I want to purchase land and build a house on it, then sell it for a return on investment. How do I go about doing that? Hard money ? So Josh, how difficult is it for someone to buy land and build a house when their work experience isn't there, if you will?
It's really hard.
Unless you have gas.
Depending on how sporadic that work history is. A gap of employment is acceptable. We need to explain it. With an FHA loan, we need to be back on the job for 6 months. With a conventional loan, we don't have that 6-month requirement, but it has to make sense. And we have to be able to paint the picture to a lender that you are a good credit risk. In this context, none of those are construction loans. So a gap of employment is going to ratchet up the difficulty in qualifying for a construction loan. The important thing to remember with hard money, The hard money lender relies heavily on your equity position in the property. So if you own a chunk of land that was valuable and free and clear and you want to build a house on it, well, there's equity in the land, in the dirt that you own. Otherwise, you need to come in with a fairly large down payment. I would step back and say, I just question the premise that it's going to be easy to step in and buy a piece of land and build a property and then sell it and make money. We had started off the show tonight, Jeb, with existing home sales reports. We had new home sales yesterday, and builders are more pessimistic than they have been since 2006. They're much more optimistic than 2006, 2007, but the most pessimistic they have been since that time. So if builders who have billions of dollars and do this professionally at scale are concerned and pessimistic about doing that at a profit, if you haven't done this regularly or have a background in the trades, I would question that it's going to be super easy way for you to make some money in this market.
Agreed. Yeah. And that's not just that's not crapping on your idea. It's just something you need to add to your thought process when you're going through it. Doesn't mean it can't be done. Just means, when the pros aren't doing it, maybe it's time to step back and reconsider. So
we saw another headline this week, Jeb. Flippers' profit of flipped homes is at the lowest level in like 10 or 12 years. And again, some of those people are newbies stepping in and flipping their first home. A lot of those people do it professionally, and their margins are at the lowest levels they've been in a long time.
Well, that and tradespeople. Contractors. Here in Southern California, contractors are still busy. Builders are still, these guys, all electricians, plumbers, whatever, they're still all busy, and they're charging a premium. So until the market slows enough where those premiums come down, the cost of building is going to be, the expense is going to be still at that higher end, and it just makes it more difficult to do. So, not telling you can't do it, just saying something to definitely consider before taking the plunge. Charmaine owns a home in Fontana with her sister, looking to downsize. Would it make more sense to sell than buy in the spring of 2023? Not necessarily. Maybe. Obviously, this is a difficult question to answer without all the context. What I would say is, you're local, reach out to me. We can have a conversation off air. I talked to somebody recently from a couple weeks ago, and we discussed their situation, and it can make sense, but it's not just a black and white answer where there's not things to consider kind of in between, if you will. So let's chat and see if we can guide you. Yeah.
Let me ask you a question about this.
Yep.
I think we all do this. We're not really realizing that it's going to be January 1 in about 5 minutes. This weekend, it's going to be Christmas. Following weekend, it's going to be New Year's Eve. And then it is January, saying, would it make more sense to sell and then buy in the spring of 2023? Spring of 2023 is like 90 days away. So if your home was ready to put a for sale sign in the yard today, and it took 2-3 weeks to put it under contract, 30 days to close, we're almost to spring right there. So we're not even talking, there's not a lot of time to do it if you wanted to do it and thought that was the best timing. We all have this perception of time that there's so much available. Well, selling a home isn't something that happens overnight. Maybe it did 2 years ago, but in the current market, there takes a little time, effort, and planning. So if you wanted to accomplish that versus pushing it off further in the future, you need to have that conversation with Jeb or a real estate pro, another real estate pro, earlier rather than later.
Yeah, no, well said, Josh. It's one of those things that what are you trying to accomplish, I guess, is probably the biggest question I would ask you. So if you're going to call me, that's what I'm going to start with. What are you trying to accomplish by selling now and buying something in the spring? Is it the idea that you're going to get more money for the property now and you're going to be able to buy something less expensive in the spring? Or are you planning to buy something in the spring anyway, and you want to have the money readily available so that when the right property comes up, you can buy it? So now is what you're thinking. So that's kind of where my head is going, but reach out and we can have that conversation a little bit more detail. Edgar says, as a first-time home buyer, personally, what would you do as far as becoming a homeowner? My area is skyrocketing, but prices are lowering. So area has skyrocketed, but prices are coming down, is what I assume. But I am waiting a bit longer. Should I wait until later in 2023? You should buy when it's right for you. When you find the right property, you're comfortable with the payment, and there's no right or wrong answer to this unless you're stretching yourself, unless you're not comfortable with the payment, unless you're buying a house that you don't really like because you just want to buy something, right? Here's the thing. You buy a house today and prices go down a little bit in that market in 2 months, you're going to wish you had waited, right? You buy that house today, prices go up in 2 months, you're going to wish you had purchased. You just need to have that longer term time horizon and not worry about tomorrow. And that seems crazy. I'm saying don't worry about tomorrow, but in all reality, you got to have a place to live. What's the alternative? You continue to rent, or you continue to save money to put yourself in a better position. Whatever the answer is, you got to do what's right for you. So, I mean, it's difficult for Josh and I to come and answer that. But I think owning real estate is important for people. It's important for long-term generational wealth. Doesn't mean you need to do it today, but it's definitely something that you should consider doing. So when you find the right property, pull the trigger.
Jeb, you just answered another question here.
Okay.
When's a good time to buy? That was a version of it. He's saying, hey, is now a good time for me to buy? Is waiting a good time for me to buy? When is a good time to buy? We've talked about this probably 100 times on the show. A good time to buy is when it's right for you in your life. You've reached a position of financial and personal stability, whether that's a relationship, whether it's a job, whether it's a location. Financially, you have income, you have reserves, you have good credit, so you qualify for a good loan. And then, as Jeb said, that you're positioned to be in an area for 5 to 7 years. When all those criteria are met, it is a good time to buy. You will not suffer if you have a long view and you look at home ownership as an important part of both your life, your lifestyle, and your finances. So there's not really a right answer to that. You have to go through and answer all of those questions. And sort of a flip side to it is, when is it not a good time to buy? It's not a good time to buy if you're in an uncertain relationship with a significant other. It's not a good time to buy if you're going to be changing careers.
So if I just met somebody on 10, hey, I hooked somebody up tonight here, it's not a good time to buy. Dude, this is my
They need to go out on a couple dates. They need to go out on a couple dates in the
dating site. You're hurting it before it ever gets started.
No, they have to be in a stable, committed relationship as part of our dating site.
No, we decide that, Josh. We decide if they're stable.
It's an arranged marriage. I gotcha.
Yes.
But seriously though, when's it not a good time to buy? You're not clear in a relationship. You're not clear in terms of, are we going to be having more children, first children? Do we need more space? Are we going to be changing jobs, going back to school? Any number of those things can mean it's not a good time to buy, and it would make more sense to wait. But those are the things you need to debate and go through in your head.
There you go. No, absolutely. Couldn't have said it better myself. Let's see. This is kind of an easy one. Anthony says, any updates on the B of A loans for homes in Hispanic and Black communities? No, we don't really get any information on that. I mean, because it's a Bank of America program, it's all done through them. But here's what I will say. This is going to sound really bad. But Bank of America, in my opinion, like this sort of thing is more of a marketing ploy than it is anything that's really going to help in those communities. Well, is there some help? Yeah, sure. But based on the number of transactions they were trying to do and the stipulations and the guidelines they put on that, it cancels so many people out. And it's more of a headline than anything else. So I would say if you're trying to buy a house, I wouldn't get caught up in using that program per se. But have that conversation with the lender, figure out where you need to be, what you need to work on. Maybe it's an opportunity for you to use it, but maybe there's a different alternative that, helps you become a home buyer quicker, easier, by going a different route. That's what I would say. Fua. Can I get your advice on my game plan? I currently live abroad, work as a teacher, saving 85% of my income. Congrats to you. I am thinking of coming back to 2023 to buy a home in Northern Virginia. Sure. Sounds like a good game plan to me. Assuming all of the things we talked about 2 minutes ago with regards to buying a home are the same for you, right? You have a longer term time horizon, money in the bank, comfortable with the payment, you find the right house. Great. If not, just keep saving your money until the right house presents itself. Dina sold her house in the summer, been living with her parents. Will a lender ask for recent bills if no longer have any? So do you ever ask for bills, Josh?
No, you don't. So they're going to look at your credit report, and we do occasionally see credit reports that have nothing there. The only place you can get yourself into trouble is if you're not using credit at all for an extended period and there's nothing for the model to score. We've talked about this before. It is important to have a credit score. So put a cell phone or something to a credit card, pay the balance off every month, just keep using a couple of cards. We go back, we talked about credit extensively on the podcast a little while back, and it is important to have to not pay off your credit cards. People think in terms of maximizing their credit score, having zero debt is ideal. Having less than 10% on your revolving credit cards is ideal for showing the model that you're successfully using credit and not just disappearing because you couldn't handle a credit card.
Good. There's a lot of appreciative people tonight. Sherry loves the answer. Anthony thanks us, appreciates the answer. Edgar thanks us for the answer. You guys are very gracious. So thank you.
Dina also good. Thank you. Don't leave Dina out. She's thanking you as well. I think it's the season. The holidays are in the air. Everyone's feeling festive and thankful.
I like it. The music I started the show with was some version of Silent Night with a beat, just, I thought it was appropriate, I was going to go a little bit slower tempo, but that had a little bit more to it. But anyhow, Edson says, is there a max cap on seller concessions for a conventional loan? So Josh, maybe explain what a seller concession is when you answer that.
Seller concession is any credit that they are giving you at closing. Are they paying points? Are they giving you money for a buy down? Anything that shows up on your settlement statement as a credit to you as a buyer. And here is the super simple answer. If you're putting less than 10% down, 3% on a conventional loan is the maximum. If you're putting up to 10% to 25% down, they can contribute 6% of the sale price. And a situation I've never in 26 years seen, 25% or more down, they can give you up to 9% in interest party contributions. The caveat there is, remember, an investment property, no matter how much you're putting down, the most you can get from the seller is 2%.
And let's talk about VA while we're talking about seller concessions. One of the cool things about VA and seller concessions, Josh.
So the interesting thing is VA has a 4% limit on interested party contributions, but there are a number of things that are not counted in that. So you can do multiple things there. And if you have excess concessions, most times your closing costs aren't 4%. Say the seller gives you 4%, your closing costs and prepaids are 2.5%. You go, hey, what are we going to do with this extra $3,000 or $4,000? Well, you're hinting at, Jeb, you recently learned that you can use that to pay off debt. Even if you don't need it to qualify, it's a valid concession through the transaction. And if you want to, you put in your credit card bill to escrow and they pay it using that seller concession. So it's important that you are working. If you're a veteran, you're looking at getting a VA loan, there are a lot of nuances and quirks and really cool things. It's literally the most flexible loan program that we have, with some of the coolest things you can do to help veterans. So you want to make sure that you're working with someone that knows how to take advantage of all those flexibilities.
All right. Angelina is asking, are realtors having conversations with sellers about how to price their homes in the current market? I see homes in Delaware still listing and selling above what it's worth. So sure. Yeah. I mean, we should be, right? I mean, us as agents, that's our number one job, is to tell people how to price their homes or help them understand what the value of their home is. But understand there's a combination of things. One, a changing market. Two, sellers that believe their home is worth more. Sellers believe that they know more than their agent in some cases. Some cases, agents that don't understand the market they're in or how to price things or how to look at comps or what have you. So a lot of things going on in changing markets. It can be fairly difficult in some cases to price a home correctly in an appreciating market and in a depreciating market, just because of the way things are changing and how quickly they change. And all of that stuff, seasonality, all of that plays a part in it. So what I would stress is, don't get caught up in so much of what they think the home is worth. Figure out what you and your agent think it's worth based on comps, and then present your offer based on that and help them try to make sense of it. Now, is that always going to work? Of course not. But that's where you should think about it. But yes, in all reality, agents should be having that conversation. Real estate agents.
Jeb, yep. I might be nitpicking here, but these questions, or the way these things are phrased, always trigger me.
Yep.
I see homes listing and selling, selling above what they're worth. You are a bystander sitting on the sidelines, not a party to the transaction. A seller put a sign in the yard, said, I will take this much for my home. A buyer with money, a down payment and a loan said, I will pay that. An appraiser appraised it and a lender lent the money, but you're on the sideline saying it's not worth that. Just remember, worth and value of the property is what a buyer and seller in an open and free market agree to. So if it's selling, it's not priced above what it's worth. It's priced at what it is worth because two people in an open market agreed to it. And again, it was confirmed by the appraiser and the lender. The appraiser is not the arbiter of what the home's value is either. It truly is what two people that are not under duress in an open market with all available information will agree to.
Well said. Julie has a question that we don't really get very often, but it's a good question. It says, do most custom home builders only build houses over 2,000 square feet? Let's see. They market these massive homes while I'm only wanting a 3-2, possibly one level home. So understand this, Julie, is that take a market like Southern California, for example. The cost to break ground in the state of California is about $90,000, give or take a little bit, with applying for permits, zoning, all of this crazy stuff, right? It's very expensive to break ground. So when a builder builds a house or houses, in most cases, right, little infill development, or maybe they build a bigger community, they're trying to maximize profit. How do you maximize profit? Well, you make smaller lots for one, and in theory, you make either smaller houses that go higher up, 2-3-story houses, which we have a lot of here in Southern California now, in order to maximize that profit. What you don't do is build smaller homes on bigger lots because you're taking more of the available land and you're not able to maximize that price per square foot by building a smaller home. So builders are in the business of making money. And while single level homes are very much very desirable and in high demand in a lot of markets, builders are trying to maximize that profit. So the idea of getting these smaller homes, under 2,000 square feet is still considered a smaller home. You're just not going to see a lot of them, especially in a market, say like Southern California, where the cost to build is expensive, where the land is expensive. Where you're likely to see it is in, one of these markets where things are less expensive to build, maybe like the Sun Belt, some of these areas where you have more of a aging population, if you will, because that's more of what an aging population is looking for. Now, I'm not crapping on you for wanting that because a lot of people want it, but typically smaller 3-2 single level homes are boomers that want those types of properties, right? Huntington has a lot of them, but they were built in the 60s and early 70s. And a lot of them have been transformed and added onto because people need more square foot these days. So you're not going to see a lot of them out there. In fact, there's a chart. I'll try to find it here while Josh is on the phone to show what builders are building price point wise, because it gives you a really good indication of where builders are focusing their time, energy, and effort, and it's in the higher price points because they make more money in those price points. So, Josh, I'll let you answer a question here. I'm going to try to find this thing.
Oh, we have a good one here. So Tyler says, would you recommend a HELOC for anything other than using it for investing? For example, what about renovations on a home I'm not selling? I would say almost the opposite. The last thing I would want to use it for is an investment. Just depends on what your comfort level is with your knowledge and certainty. A lot of people think in terms of investing. Put it in context. I had a client last year took $300,000 out of his house in February to buy crypto. I have not had the nerve to circle back with him to see how that has gone. So if he did what he told me he was going to do, 80% of that money is gone. So $240,000 of home equity is evaporated, and he is making that increased monthly payment. So be very careful in terms of investing. Now, investing in the home, improving it, bringing it up to a higher value. Now, remember, you don't get dollar for dollar off of improvements in the big things. Kitchens, baths are going to have the biggest return. but it's a more of a guaranteed return than some of the other things. So I have no problem using a HELOC. So you're saying I'm not selling, probably have a really low interest rate locked in. So if you're borrowing a small amount on that HELOC relative to the size of your first mortgage at a really low fixed interest rate, it can be the best or the only way to finance those home improvements other than paying for them out of pocket. Did you find it, Jeb?
I did. I'm going to pull it up right now. Let's see what we got here. Maybe not. I don't know where I saved it.
All right. I'm going to answer another one, but it's not a long one, so you better hurry.
No, I got it. Go ahead.
Laker J says, hey, gentlemen, question. How accurate is the Credit Karma estimated home equity tool? Couple things. Any of the home equity tools are estimating what your current loan balance is, which they don't know your interest rate unless you have an adjustable rate mortgage. So they have to say, what was the going rate at that time, which you could have a higher or lower rate, and assuming that you did not make any additional principal payments over the life of that loan. Then they also have the requirement of they have to estimate what the home is worth. All of those algorithms are good, but they have margins for error, and how homogenous your neighborhood and homes in your area are will dictate how accurate it is. So is it accurate? I mean, it shouldn't be horrific, but it's probably not super tremendously accurate either.
Good stuff. All right. So this is the chart that I was actually talking about here. So this shows new home sales by price. And if you look on this side, this is the percent of sales in that price point. So you can see homes that are under 300,000 are here in the red. Less than 10% of those homes are what builders are actually building. But you can see here, as you kind of go up, the homes between 300 and 400,000 make up about what, 20% or so of the market. 400 to 500,000, about 10%, 20%. What is that number? 20%. And then as you go up here, 5 to 700 or 5 to 750 makes up again about what, from almost 85%. So about 25% of the market. And then you can see there above 750 is about another 10%. So anywhere between 5 and 750,000 above makes up 35% of the market of where builders are kind of focusing their attention. They're there to make money. That's why. And that's
Jeb,
why you're seeing bigger homes being built. Yeah.
I would also, I push back a little bit on that. It's 100% true. Builders are in it for profit maximization. Well, if they could make the most money building 1,300 square foot, 3-bedroom, 2-bath entry-level homes, that's what they would do.
Yep.
But it isn't. But if you go back to that chart, we don't need to, but if you go back to that chart, if you invert the trend line of those red, and then you also do a median home price chart, that's almost identical. Because if you look, we had the most back in, 2010. So when home prices were at their lowest, we had the most homes built under $300,000. And then we had a slow down trend as home prices were slowly going up. And then in the pandemic, home prices skyrocket, and then they just drop off of a cliff. This is a function of home prices everywhere going up. So people put this chart up and say, see, builders don't want to build cheap homes anymore. And you go, no, because if we look at existing homes are going to do the same thing because there's just not inventory in those price points in most areas any longer. It may be exacerbated because builders are trying to maximize their profits, but that chart, that trend line will look exactly like what home prices have done.
No, yeah, understood. Yeah, there's just less homes out there in that price point to start with. So,
yep.
Yeah, that makes sense. Let's see. Tom doesn't have a question. Just joking on my beer here. Says my 5 o'clock shadow. It's a good 5 o'clock shadow that quick. Jeb. I went to school with a guy that literally grew like a beard like this in like a week. He was like 7th grade. Every time I see him, I'm like, I still joke on him. Let's see here. And I got another question on assumable mortgages. Josh, this is something I need to do a video on assumable mortgages. This is what I've determined because there's a lot of questions.
Just post the link the 5 times a week when this question gets asked.
But have either of you done mortgage assumptions for VA or FHA loans? It's an amazing option for both buyers and sellers when the locked in rate is low. Yes, it is an amazing option. But understand,
it's an amazing idea.
It is. But here's the big thing that people don't understand. For one, you're assuming the loan, right? Josh and I talk about this all the time. Josh, a normal lender can't do an assumption. You have to call the lender that is currently financing the loan for that homeowner, right? You have to deal with
Yep.
their bank to see if you qualify. But let's say, for example, you have a home that's worth $500,000 and the owner on that property only owes $300,000. Well, when you go to assume that mortgage, the bank is assuming, $300,000 mortgage. That's what you're assuming, and assuming you qualify, that's great. But there's a $200,000 disparity there between what the house is worth and the loan that you're getting on it that you are going to have to pay that homeowner some way, right? So the homeowner's typically only going to allow you to assume their mortgage if they're still getting the price that they want on that property. They're not just going to walk away from that equity. Now, in some cases, they might be able to do seller financing or whatever. But when most people, at least in my experience, you can tell me if I'm wrong, when most people are thinking assumable mortgages and assumption and taking over, they're thinking, I'm coming in with very little to no money down, and I'm going to take over somebody's mortgage and take over the super low rate and not really have to come in with anything. That only works if that person doesn't have any equity at all and they're willing to work with you in that way. Most people aren't doing that. And so I know there's a lot of talk on subject to and all of this stuff that's floating around the internet. Understand it is more of a headline grabber than it is anything that is truly a functioning tool in this market. And the only reason it's being discussed whatsoever is because rates have gone up, right? As interest rates moderate, it's going to be less of a topic. Josh? Anything?
No, 100%. We talk about it all the time. And specifically, have we done them? No, we haven't done them because as a mortgage lender, you would go directly to the lender that holds the loan if you were to do it. But what I will say in the answer to that question, Jeb, I have a huge network. I do a live every Tuesday with 3 to 4 lenders from around the country. I don't know, and that's VA specific, VA loans being assumable. I don't know of anyone who has been involved in one, been around one, actually being done. It's one of these fun topics for the internet to talk about. The loans are assumable. They very rarely, if ever, get assumed.
Good. Edson, I've been able to get sellers to offer closing cost and permanent rate buy down on new construction homes. Would you advise that offer, or would negotiating a lower price always be the best approach? To each his own. I don't know that there's a surefire way that works for everyone. I mean, what are the benefits of getting a seller to do closing costs and the buy down? Less money out of your pocket, potentially lower rate equals lower monthly payment. What's the benefits of just getting the lower price? Well, I mean, chances are your rate's going to be higher unless you buy it down yourself. So you're going to have a higher rate, but your property taxes are potentially lower based off that lower purchase price. If rates go lower and you're able to refinance in the future, you didn't really lose much by not having that built in there, and you have the lower price home. So I don't know that there's a right or wrong answer, but what I can say is that, doing this for as long as I have, and Josh and I having this conversation and knowing the mindset of people and how they operate, people live in the payment and not the price of things. As much as they want to tell you that they want the lower price, they care about the payment. And that is 100% accurate. And nobody, you can't argue it. And as much as people want to do it, it's not a valid argument because I know how people live. And so with that said, if you're one of those people that truly lives in the payment, then take the buy down and understand the risk and the sunk cost that's involved. If you're one of those people that on the other side think that rates will come down and you're comfortable with the payment as it stands and you think there's going to be an opportunity to take advantage of it, then maybe that's the right move for you.
Well, Jeb, it ignores the fact that the builder is probably not going to give you the option of lowering the price. The reason why the builders are the most aggressive with rate buy downs and closing costs is they are the ones that need to protect their sales. They don't want someone who bought 6 months from them coming and going, hey, a-holes, why are you selling these homes cheaper? They will do everything possible to protect that last sale. So assume that you go, no, this is nuts. I don't want all that free money. I want the home at the price that it should be, the net price, net of those concessions. If they have another buyer who says, oh, I'm cool, I'll take it with those concessions, they're going to sell it to that buyer. The only way they're going to give it to you at the lower price is if that is their last and only option for selling that home, because it is very important to them to protect the last sale price.
Agreed. I didn't even think about that piece, but yeah, you're 100% right on that. On that same topic, Suffering Sucks says, I was getting excited about sub 2 and Pace Morby. Yeah, I mean, he's kind of the sub 2 guy, right? I mean, he is, you watch his channel, you get excited and makes it sound super easy. And for some people it might be, and in some markets it might be a little bit easier. I would just tell you it is. I don't know him. Haven't done subject to, but he is making it sound way easier than it actually is. And there's some discrepancies in what he said that I personally have a problem with, that I don't think are accurate. But again, I don't know that to be true. It's just my personal feeling. So
I know for a fact he is legit. He is personally doing subject to deals. But just remember how many deals he gets in front of versus the normal person. Not only is he a buyer, a wholesaler, a buy and hold investor, he runs a coaching program, and the coaching program brings him deals. Like if you've gone down the rabbit hole of signing up for any of his stuff, it's, hey, partner with us. Hey, you don't know anything. You don't know how to make a deal work, or hey, you've painted yourself into a corner. You have a property under contract. Call us. We'll fix it for you. Well, guess what? 99 times out of 100, there is no fix. But 1 out of 100, a sharp investor like Pace and his team can put a deal together that works. So if you watch his videos, he can give you video after video of real stories, transactions they closed on that are good deals.
Oh, absolutely.
The key to being a successful investor, Jeb, is deal flow. If you get in front of 2 deals a year, the odds of you getting a good deal are not great. When you're him and you're getting in front of 122 deals a month, you're going to have good and interesting deals. And those tools in your toolbox, an all-inclusive trust deed, subject to, all that stuff is good and awesome. And he's a smart dude and he understands how to use it. But it's a little disingenuous to think someone who's never been an investor and never bought a home is just going to step in and go, let me buy this $599 course and I'm going to go do subject to deals.
No, and I believe all of that. I mean, the issue that I have or the thing that I have an issue about is some of the things with regards to,
do on sale insurance.
Well, not even do on sell insurance is the idea that, hey, listen, you're buying a new property and you need to sell your property. So you sell it to me subject to, and somehow the lender is just going to allow that debt, to just not be looked at when you go qualify for the new home. And it's like, I don't know any lender that's going to overlook the fact that you have a mortgage on your credit report. Even if the deed has been assigned to me, you are still responsible for that money. And most lenders are going to look at that and go, we need proof that somebody else is making those payments and have made those payments for X period of time, not to take that debt into consideration. And so when I hear those stories, makes it sound like, hey, listen, this is just, an easy fix. Like it's very common. No, it's not. And maybe he's getting it done with some banks or whatever, but he makes it sound to the average person out there that doesn't understand anything like, hey, it's this easy. So just understand when he's a professional at this. Most people doing it are not, right? They're watching a video, getting hopeful and trying to accomplish the same thing. Brandon has a question. My new construction house has been delayed for 7 months. I now need a car. Any suggestions on the situation, or is my only option a cash car? So Josh, what do you do with somebody in the position like this?
So unless your qualifications were pinned at the absolute max, or the rise in interest rates over the last 7 months has taken you and pinned your qualifications to the max, you would be able to buy some type of car. So you need to talk to your lender and say, what is my current debt to income ratio? If I buy this car, and it has a payment of $375 a month, what does that do to my debt to income ratio? And am I still good? If you're asking us, you probably have already asked your lender, but if you haven't, that's the question. Go out, shop for cars, do not buy one, find out ballpark, what is my monthly payment going to look like? Call your lender and go through it, or call your lender before you go shopping for cars and say, hey, what's the most I can handle on a payment? Now be careful. You walk onto a car lot and you tell one of the sharks, I mean, salespeople, that you need a new car and you can afford $382 and not a dollar more. They'll give you
payment's going to be $382.
$122-month loan on a cheap little car with a $382 a month payment.
Yeah, no, exactly. So just, talk to your lender. I think that's the right advice. Zachary's, if already pre-approved, but have credit cards that are high payment and need to be paid off, is it better to save money for a down payment or pay the cards off first? Realtor and lender said to save. Josh, what are your thoughts on that?
Need a little bit more information because you say already pre-qualified. Are there problems with the pre-qualification? Is it too low and you need to qualify for more to buy a home in your area that you'd be happy with? It sounds like there is an issue here because we're saying, should I save more or should I pay the debt off? Saving more, we've talked about this before. For every $1,000 more you put down on a home with current interest rates, it saves you about $6. So $10,000 would save you about $60. If you pay off $10,000 of credit card, it's going to save you $150 to $300 a month. So in terms of maximizing your qualifications, putting you in a better position, paying down the debt is going to have a much, much bigger difference. As realtor and lender said to save to put down or save to pay off the debt. Paying off the debt is going to make more sense. I would rather have someone put 3% down and pay off a bunch of debt than put 5% down and go into that deal with more debt, if that makes sense.
Good. Let's see what we have. Josh, I'm going to put this up here because it's comment that I'm going to kind of throw something your way here, Josh. So Edson just says, appreciate you answering my questions. Want to give everyone a heads up to check with their local credit union. They may have some great offers for first-time homeowners. So credit unions occasionally do have some good programs. They can be restrictive, having overlays on certain things that make it more restrictive in some cases. But Josh actually has access to a credit union program that the credit union itself doesn't even have necessarily access to, that I think you're not on the retail side. So Josh, how does someone learn about these programs? What's the difference in that program versus say a bank? Why is that, how does it help
unions,
people?
Yeah, credit unions are a unique animal. The only way they're going to save you money is if they actually do make the loans and hold the loans. So it's going to be a big credit union. So if you're somewhere in a more rural area, a small area, and you have a small local credit union, funny thing is, Jeb, Jeb and I are here in Huntington Beach. There's a Huntington Beach Employees Credit Union. There's one branch. They're in the basement over at City Hall. They do not make any loans. So a lot of credit unions hook up with a mortgage company, and the mortgage company does the loans in the name of the credit union. Those deals are going to be worse, if anything, than you can get. But some of the really big credit unions they don't necessarily do, but they can have really good deals. So from that perspective, it's just calling on the phone and talking to them and saying, what are the requirements? Like you said, Jeb, what are your overlays? What do you have above and beyond what Freddie and Fannie would require? Because most of them do, not all, but most of them do, but they'll do things outside of the box if they are a portfolio lender, making loans from depository funds at the credit union. So what I was going to say, what you already said, best of all worlds, get with a broker that has access to a credit union or two. We have three monster credit unions. Two are sort of niche-y. They do different, unique stuff that other lenders don't do. And one of them is more vanilla, but really good terms in that they loan their own money. So they make their guidelines. They're doing jumbo loans with Fannie Mae, Freddie Mac guidelines at better terms than Fannie and Freddie and jumbo lenders are doing. So for us, unfortunately, we have to be in their footprint. They only lend in the 8 Southern California counties. So if you're in one of those counties, we can offer it. The other two are more nationwide credit unions. All credit unions sort of have a criteria for what it takes to be a member. So the other two, we can get people approved nationwide. The biggest one, the one that we have the unique tool, is more just for Southern Californians. So it's a good option to pursue, But what you'll find is most credit unions don't have great terms, don't have anything out of the norm, but some of the bigger ones that make loans out of their depository funds absolutely do.
Good. Let's see. We have been on for 1 hour and 20 minutes. Would like to ask a favor if you found any value, if we've answered your question. If you want to, get a shirt that looks like Josh's for Christmas, hit the thumbs up. If you want to hear the way Josh just destroyed that water bottle right into the mic, hit the thumbs up. No, we appreciate you being here. We appreciate the support. And that's how the show gets more people seeing it, more people following it and listening to it. So we appreciate you. All right. So that we've answered all the questions, Josh. We are here. We're done. The night's over, bro.
It's the holiday season. Last week it was 75 minutes in. This week 81 minutes in. But I'm happy that 178 people showed up and asked questions about housing during the holiday season.
Well, let's at least get here to the half hour. We got 10 more minutes. Let's just keep going here. Let's what do you want to talk about, Josh? What do you want for Christmas, Josh? What do you want for Christmas?
I have everything I want. I'm the luckiest man on earth. I've got a wonderful dog and a wonderful wife and a wonderful life. So I have nothing to complain about. Where are you and your lovely family going to be spending Christmas?
We are going to be here locally, Huntington Beach, not going anywhere. We typically do it at our house on Christmas Eve. The in-laws will come over and we'll hang out. We do fondue. I'm not a fan of fondue.
Fondue is not a Christmas meal.
I'm not a fondue fan. I don't believe that I should. This is going to sound really bad. I don't like to cook my own food while I'm trying to eat it.
Well, fondue, you're not cooking it. You're dipping it. It's already cooked.
We're cooking it.
We're not shabu shabu.
This is like shabu shabu. We have raw meat.
Fondue and shabu shabu are two different things.
Ribeye. And we fondue it and put it in sauces and all that stuff. So it's not, I guess, they call it fondue, but we're basically shabu type deal here. And so we're putting it in oil and frying our own meat. So we're eating it one piece at a time. I don't like that, bro. I like to eat. When I want to eat, I want to eat. Like, that's where I'm at. I don't like going to Korean barbecue and Japanese barbecues and having to pay to cook my own food either. So I'm one of those weird people. I like the food. I think it tastes good, but anyway, I digress. So that's what we're doing.
All right.
And like you, I don't need a lot. Pretty happy with where I am. Kids are healthy. Kids are happy. Wife is good. Hopefully she's happy. But
what Jeb and I mean to say is that whenever we see a trinket that we like, we find it irresistible to just buy. Yeah. So there's not a lot left at Christmas time.
That is sad to say, but that is accurate. I'm very difficult to shop for because what I want, I just buy it most of the time. And I don't really buy big things. So it's like, I get a new phone a year, that sort of thing. That's about it. Anyway.
Jeb, we do have a question. Darren Buttery says, I currently own a home with an estimated value of 185 and I owe 152. So it's an 82% loan to value. I have high interest credit card with a 5K balance. There's a way to tap equity. A HELOC, a fixed second. Most credit unions, let's go back to credit unions. Credit unions are very good for home equity lines of credit and second mortgages. Most of them will allow you to go to 90%. So 5,000 is what, 2.5%, 3% on that loan to value. So you're still going to be under 90. That would absolutely be an option for you.
Yeah, but I mean, I'm going to go the other direction and say, just pay off the credit card. Like, just budget and pay it off. It's $5,000. Like, make some changes and make that happen versus the cost to refinance for a $5,000 loan. I mean, I don't even know what that cost is. I think it's in your best interest just to figure out how to make the do a couple of jobs on the side and make the $5,000 and pay it off. Leave your equity and your home alone. I know that's easier said than probably done, but that's my thoughts. Josh.
This one is going to be difficult for us to answer accurately, but we're going to give a broad and general answer that should get you in the ballpark. Veronica Thornton says, how do states like VA charge interest for their down payment assistance program? Do they get interest on your home even if you pay off the loan and don't plan to sell? So most down payment assistance programs through cities and states are government funded through bond financing. So they're below market interest rates and sometimes zero interest rates. So depending on the down payment assistance program, it may not accrue any interest. It may accrue interest at 2.5%, 3.5%, a very low rate with no payments required. So in California, we have the California Housing and Finance Authority. They have a zero interest program. And then they also have a second mortgage program that does have, I believe it's 3.5% interest charge, but you don't make payments on either of those. So one, someday you're going to have to pay off that loan when you sell or refinance. The other one, you're going to have to pay off the loan plus interest when you sell or refinance. For us in California, that California Housing and Finance Authority program, they don't have an ownership interest in your home. They have a lien against your home, and they'll get something back in the future. I know there are states where there's recapture and or equity participation. So you need to check the details on your program, and you need to make sure that you're working with someone. If you're looking at any down payment assistance program, I think it's important that you talk to someone that does them regularly and does loans, standard loans, and is capable of honestly and truthfully walking you through what are the pros and cons of each. Because for most of these programs, there's no free money. It's not like, oh, that's a no-brainer, I'm going that route. You need someone who can honestly walk you through the good and the bad of both options.
Good stuff. Great answer. I think we're just going to end it there, guys. We will be back next week. I think Josh will be here. If not, I'll be here by myself, but we will be doing the last show of the year next Wednesday, 5:00. For those of you who aren't aware, didn't hear us earlier, this show will be on the Educated HomeBuyer Live podcast on Friday morning. If you want to listen to it audio, if you didn't hear the whole thing, you can always go back and watch it on here as well. This week on the episode on the podcast, rather, we were talking about how to write an offer. We'll do the second part of that series next Tuesday, kind of guiding you through that process. It's more or less an all-encompassing guide, if you will, as to buying a home, where to start, next steps, so on and so forth. So we're taking you through that journey. So if you're planning to buy a home in 2023, make sure you check it out, share it with a friend. But either way, we appreciate the support, appreciate you being here every week, showing up, answering or asking questions, rather, allowing us to do what we feel we're good at. So I'm grateful for you. Happy holidays, Merry Christmas, all of that good stuff. Josh.
Merry Christmas and adios.